Let's talk about Target. The stock moving firmly to the downside after missing first quarter estimates and cutting its full year sales outlook. The retailer hit by weak consumer spending, tariff uncertainty, and backlash against its DEI rollback. The stock down a little over 6%. Joining us now, Bill Kirk, Roth Capital Partners Senior Research Analyst. Bill, great to have you on this morning. I want to get your reaction to this print, the uncertainty that Target talked about in comparison to what we're hearing from other retailers. Do you think that the price action at the downside is justified based off of what we got out of this print?
Thanks for having me. And yes, simply put, I do think the price action is justified. You kind of led with compared to other retailers, and I think that's a great way to do it. If you contrast Target's results today to Walmart's last week, you see a stark difference. Target comparable store sales decelerated from plus 1.5 last quarter to minus 3.8 this quarter. Take Walmart. Walmart did 4.8 this quarter from 4.9 last quarter. So no change at Walmart on comparable store sales and a deceleration of 5 percentage points at Target. If you do profitability, Walmart earnings this quarter up year over year, slightly, but up. Target EPS, adjusted EPS, down 35% or so year over year. So I think when you contrast it against other retailers, in particular Walmart, the price action this morning is justified.
Walmart was talking about raising prices. Does Target need to do the same?
Target needs to, in the sense that input costs are going to be up for tariffs. They have a larger tariff exposure than even Walmart, but Target's in a trickier position because their assortment is a little bit more expensive and it may be priced too highly to begin with. So it's a little bit harder for them to go and raise prices when the consumer doesn't seem to love their price points to begin with, right? So they're in a trickier kind of in between a rock and a hard place where, yes, they will have to raise prices to offset input cost inflation, but consumers are already not thrilled with their price points today.
And it's interesting because given the uncertainty in the macro environment, Amy Wu Silverman telling me earlier this week, this is a moment where investors are betting on management versus companies overall. Is this a moment then where Brian Cornell's leadership comes into question?
He's managed a lot of different volatile periods. So he has experience in these difficult periods. But what I would say is, they keep talking about longer term. We feel great about the growth opportunities. We feel great about the profit opportunities, but they haven't grown over the last 4 years, right? They haven't basically grown since 2021, and profitability is about half of what it was. So maybe longer term it's out there, but I would consider 4 years part of the longer term, and they haven't had it materialize. They're in a tricky position where they need to catch up to Walmart, and that requires a lot of spending. And they don't quite have the ammunition available for spending. This goes back a few years, but in that 2021, 2022 period, they went and did 10 billion plus in share buybacks. The stock is down more than 50% since they did the 10 billion in buybacks. So they lost a lot of money on those share repurchases. But more importantly, that 10 billion would have been wonderful to invest behind the business back then on the technology initiatives, behind pricing. Invest some of that 10 billion 4 years ago behind pricing, and they would be in a much better spot today to compete than they are.
Bill, I was taking a look at a note from Apollo chief economist Torsten Slok this morning saying that up to 10% of households in May 2025 could face a steep decline in their credit score because of what we know has been coming for a while in this student loan repayment cliff, essentially. As you're thinking about that, does Target have a more outsized student loan repayment issue and problem on its hands, given its mix and the overall inventory it has?
I think yes, and I think you're right. It does come down to the mix. They just sell more discretionary product than a lot of the other retailers I cover, right? They sell more discretionary things you don't necessarily need items. They sell more than Walmart. They obviously sell more than the pure food retailers like Kroger and Albertsons. So from a mix perspective relative to those names, yes, they would have more exposure to any sort of tightening of the budget because those discretionary items are the first thing to go. They go before discretionary experiences. People don't like to cut travel and experience on the discretionary side, but they will cut discretionary, physical, tangible items.
That's really good context then, Bill. It makes me wonder, let's say you had a career change and you went into consulting and Target brings you on staff. What is the data point that you are whispering in Brian Cornell's ear to really focus on to improve and turn around back to that growth story that you mentioned?
It would be you have to take the pain today of announcing a very large investment period. You have to tell Wall Street that earnings are going to be muted for a while, but we think if we put this money behind technology and we put this money behind price, we can get back to that long-term growth, right? They're promising long-term growth, but don't really have the actions to deliver it, right? The actions they talk about are kind of nebulous, right? They say things like, we're going to bring back the Target magic. That's fine, but I don't even quite know what that means, right? So my advice would be increase investment, physical investment on the capital side behind technology and behind price. Yes, that will mute earnings for a while and it would probably come with an earnings decline, but that's what needs to be done to deliver this longer term promise you keep offering.
I guess with that in mind, how long does it take from what you've studied in the past and what you've ultimately witnessed at other retailers when there is a more kind of consumption mindset shift, and specifically thinking about the diversity, equity, inclusion, walk back, and now the backlash that is taking place? At what point does that become a more permanent fixture in consumers' mindset?
I think we're evolving toward that, right? Like, you have to ask yourself, what makes Target unique? What can they do, or what are they doing today that's different than other retailers? And I just feel like that list of what is unique is getting smaller. They still have some great partnerships, right? They have great partnerships with Ulta. They do great in the private label brands, particularly in apparel with things like Cat and Jack. So they do have some of those things, but that list of what is unique about Target keeps getting smaller. And then when you talk about what can Target do, like what are their capabilities, it narrows even further. If you look at like e-commerce, they're behind Walmart on e-commerce. Target's e-commerce business grew 5% year over year. Walmart's grew 22. Walmart's is an order of magnitude larger than Target's already, and it's outgrowing. The growth rate is 4 times higher. So they're very far behind, and I struggle with what makes them unique in this current environment. And that goes back to your point of consumers aren't compelled to use Target in the same way they once were. And that makes boycotting a lot easier. Regardless of who's doing the boycott, if you're not compelled to use Target for a particular reason, it makes a boycott far simpler to execute.
Bill, good to have you here with us this morning. Ahead of the market open here, we're going to continue to track shares of TGT. Thank you.
Thank you.